Welcome back to Old Men, New Money. I'm Douglas Borthwick, and today we're continuing our deep dive into corporate treasury strategies. Last episode, we covered Strategy, the MicroStrategy turned Bitcoin accumulation machine, the pioneer, the company that proved the treasury model works. Today, we're looking at a completely different approach, BitMine, ticker BMNR, and their audacious goal to accumulate 5% of all Ethereum in existence. Not Bitcoin, Ethereum. And that distinction matters more than you think. Because while Strategy is betting on Bitcoin as digital gold, BitMine is betting on Ethereum as the infrastructure layer for the future of finance. And they've got Tom Lee, co-founder of Fundstrat and one of the most respected voices on Wall Street, leading this charge. This is the story of how a Bitcoin mining company with fancy cooling technology completely pivoted to become the world's largest Ethereum treasury, and why that might be one of the smartest strategic moves in crypto. Here's your 30-second version. BitMine is the world's largest Ethereum treasury company, holding over 3 million ETH worth approximately $12.9 billion. In June of 2025, Tom Lee took over as chairman and pivoted the company from Bitcoin mining to Ethereum accumulation. Their goal is to acquire 5% of all Ethereum's supply. Unlike Bitcoin, Ethereum can be staked for yield, currently earning around 2.5 to 3% annually. BitMine's thesis is that Wall Street, stablecoins, and AI are all building on Ethereum, creating what Tom Lee calls a supercycle. They've raised billions through aggressive capital markets activity and trade with massive liquidity. We're at this inflection point where Bitcoin and Ethereum are diverging as assets. Bitcoin's solidifying its position as digital gold, store of value, macro hedge, the asset you hold through economic chaos. Strategy's model is perfect for that. But Ethereum is something different. It's a platform, it's infrastructure, smart contracts, DeFi, stablecoins, tokenized assets. All of this is being built primarily on Ethereum. BlackRock's tokenized treasury fund, built on Ethereum. Over $280 billion in stablecoins, most of that's on Ethereum. Wall Street's blockchain experiments, overwhelmingly Ethereum. BitMine is betting that the infrastructure layer is more valuable long-term than just being digital gold, and Tom Lee, who's been bullish on both Bitcoin and Ethereum for years, putting his reputation behind this thesis. BitMine started as something completely different from what it is today. The company was originally focused on Bitcoin mining, but with a twist. They had developed this proprietary immersion cooling technology. Instead of using fans and air conditioning to cool Bitcoin miners, they submerged the equipment in specialized cooling fluid. This was actually innovative. Immersion cooling is more efficient, more reliable, and allows higher density mining operations. It's good technology. But in June of 2025, everything changed. Tom Lee joined as chairman, and within weeks, the company announced a complete strategic pivot. They're getting out of Bitcoin mining, they're liquidating mining equipment, and they're going all in on Ethereum accumulation. Not just buying some Ethereum for the balance sheet, they're setting a goal to accumulate 5% of Ethereum's entire supply. That's 6.1 million ETH. At current prices, that's around $25 billion. This is MicroStrategy's playbook, but for Ethereum, and with a specific percentage of supply target that makes the goal concrete. Now, to understand BitMine, you have to understand Tom Lee's thesis, because he's not just some crypto bro. He's a Wall Street veteran, decades at JP Morgan as chief equity strategist, co-founded Fundstrat. He's been right on major market calls, including being one of the few strategically bullish voices during tough periods. His Ethereum thesis has 3 pillars. First, Wall Street is building on Ethereum. When JP Morgan does blockchain experiments, it's on Ethereum. When BlackRock tokenizes treasuries, it's on Ethereum. The institutional infrastructure is Ethereum native. Second, stablecoins equal Ethereum demand. There are over $280 billion in stablecoins right now. Most are on Ethereum. Coin transaction requires ETH for gas fees. As stablecoin usage grows, Ethereum demand grows. Third, AI and tokenization converge in Ethereum. As AI models need payment rails for microtransactions, as data becomes tokenized, as new economic models emerge, they'll predominantly be built on Ethereum because that's where the developer ecosystem and tooling are. Lee talks about Ethereum entering a supercycle, not just a bull market, a structural shift in adoption that drives sustained demand for ETH as an asset. And then there's this concept of the sovereign put. And this is fascinating. Let me explain what Tom Lee means by sovereign put. As institutions and governments need Ethereum exposure, they face a problem. If they go to open markets and start buying massive amounts of ETH, they'll drive the price up against themselves. Slippage, market impact, front-running, all these issues. But if BitMine already holds 3 million or 5 million or 6 million ETH, institutions can partner with BitMine instead. OTC transactions, structured products, loans against ETH collateral, ways to get exposure without moving the market. BitMine becomes the sovereign put, the entity that large players can transact with for size without impacting market prices. This is similar to what central banks do with gold. They transact with each other over the counter at scale. BitMine wants to be that for Ethereum. Now, whether this actually plays out as Tom envisions remains to be seen, but the strategic logic is sound. If you believe institutions are coming to Ethereum, having massive holdings positions you as a critical counterparty. So, how does BitMine actually accumulate Ethereum? Similar to Strategy, they become a capital-raising machine. They're issuing equity, preferred stock, and they're moving fast. In August of 2025 alone, they raised over $1.7 billion and immediately deployed it. $1.7 billion in 1 week. That's aggressive. They're not waiting for perfect entry points. They're not trying to time the market. Their strategy is continuous accumulation, dollar cost averaging at massive institutional scale. As of October of 2025, they hold over 3 million ETH. That's approximately $12.9 billion. That makes them the world's largest Ethereum Treasury and the second largest crypto treasury overall, right behind Strategy's Bitcoin hoard. They're about halfway to their 5% goal, another 3 million ETH to go. At current ETH prices around $4,000, that means buying another $12 billion worth. That's a lot of capital to raise, but they've demonstrated they can do it. And here's where BitMine differs fundamentally from Strategy. Ethereum generates yield. Bitcoin doesn't. When you stake Ethereum, you earn rewards for helping secure the network. Currently, staking yields are around 2.5 to 3% annually. Not huge, but it's real income. BitMine stakes all their ETH. That 3 million ETH is earning about 75,000 to 90,000 ETH per year in staking rewards. That's $300 to $360 million in annual income at current prices. This is purely from staking. No capital markets activity, no financial engineering, just a protocol paying them for participation. Now compare that to Strategy. Their 640,000 Bitcoin generates zero income, nothing. They depend entirely on Bitcoin price appreciation and their ability to increase Bitcoin per share through financial engineering. BitMine gets both. They can increase ETH per share through capital raises like Strategy does, but they also get that 2.5 to 3% yield compounding their position every year. In a sideways market where prices don't move, BitMine's treasury is still growing. Strategy's isn't. And that's a fundamental difference in the business model. One thing that's remarkable about BitMine is how quickly they've achieved massive liquidity. Daily trading volume is $2.5 to $3.5 billion. That puts them in the top 30 most traded US stocks by volume, more liquid than many S&P 500 names. And this happened incredibly fast. They only pivoted to Ethereum in June. By August, they were already trading billions daily. And why does this matter? Because institutions can actually deploy capital. If you're a fund manager with $1 billion to invest, you need deep liquidity to enter and exit positions. BitMine provides that. This liquidity also enables options markets, structured products, and other derivatives. That brings in even more institutional interest. The stock has become a liquid Ethereum proxy for traditional markets, and that's exactly what they wanted. Let's talk about how to value BitMine because it's similar to Strategy but with key differences. You start with net asset value. Take their 3 million ETH times current ETH price, subtract any debt, divide by shares outstanding, that's your NAV per share. Like Strategy, BitMine trades at a premium to NAV. The market is pricing in future ETH accumulation. Tom Lee's strategic vision, the staking yield, the optionality. But unlike Strategy, you also need to value the staking income stream. If they're earning 2.5 to 3% yield on $12.9 billion in assets, that's $300 million in annual income. That income stream has value beyond just the NAV. So BitMine arguably deserves a higher premium to NAV than Strategy because there's an actual income component. You're not purely betting on price appreciation. The market seems to agree. BitMine's premium to NAV has been significant, reflecting confidence in the Ethereum thesis and Tom Lee's execution. Let's talk about where Tom thinks Ethereum's going, because this matters for the investment thesis. Lee has thrown out price targets of $30,000 for ETH. Not $5,000, not $10,000, $30,000. At current prices around $4,000, that's a 7.5 times move. And he's not talking decades. He thinks this supercycle could drive those valuations within a few years. His logic is supply and demand. Ethereum has transitioned to proof of stake, which reduced issuance dramatically. Then you've got staking, which locks up significant amounts of ETH. Then you've got DeFi, which locks up more. Then you've got stablecoins driving gas demand. Then you've got institutions building on Ethereum. He believes all these forces converge to create sustained excess demand over supply, and in that scenario, prices move dramatically higher. Now, $30,000 is a bold call. Maybe it happens, maybe it doesn't. But if you believe there's even a chance he's directionally right, BitMine at current valuations is interesting. If ETH goes to 10,000, that's a 2.5 times move. With staking yield on top, that's a pretty good return. Unlike Strategy, which had a multi-year head start and is unquestionably the Bitcoin Treasury leader, BitMine faces more competition in the Ethereum Treasury space. There are other companies considering similar strategies. Galaxy Digital holds significant ETH. Various funds and investment vehicles provide Ethereum exposure. But BitMine has first-mover advantages as the first pure-play Ethereum Treasury company at scale. They've got Tom Lee's brand and credibility. They've got the NASDAQ listing and institutional access. They've got the liquidity. And most importantly, they've got the 5% goal. That clarity of mission matters. Everyone knows what they're trying to do. Accumulate 5% of all Ethereum. That's concrete and measurable. One thing Tom Lee emphasizes is BitMine's positioning for institutional adoption. He argues that as pension funds, endowments, sovereign wealth funds, and other large institutions decide they want Ethereum exposure, they'll prefer partnering with BitMine over buying directly. Why? Size, sophistication, regulatory compliance, familiarity. BitMine can structure transactions that work for institutional risk parameters. They can provide OTC liquidity. They can create structured products. They can be a counterparty for complex trades. This institutional positioning is critical to the long-term thesis. If Ethereum becomes core to financial infrastructure, BitMine wants to be the institution that institutions transact with. Time will tell if this strategy works, but the logic is sound. Now, allow me to give you numbers to understand the scale. BitMine holds over 3 million ETH, worth approximately $12.9 billion as of October of 2025. They're approximately halfway to their 5% goal of 6.1 million ETH. Staking yields are currently 2.5 to 3% annually. On 3 million ETH, that's 75,000 to 90,000 ETH per year in staking income. At $4,000 per ETH, that's 300 million plus in annual yield. Daily trading volume is $2.5 to $3.5 billion. That makes BMNR one of the most liquid stocks on the market. They raised $1.7 billion in 1 week in August. That demonstrated their ability to tap capital markets aggressively when needed. Let's talk about risks, because this is aggressive. If it crashes, BMNR crashes harder. This is leveraged ETH exposure with a premium on top. Competition from ETFs could compress the premium. If spot Ethereum ETFs gain significant assets under management, investors might prefer those over BMNR. Cheaper, more liquid, no premium. Execution risk on the 5% goal. Raising another $12 billion to buy 3 million more ETH is not guaranteed. Market conditions could change. Shareholder support could waver. Ethereum technical risks exist. Major bugs, network failures, failed upgrades. These would impact the entire thesis, although Ethereum has been remarkably resilient so far. Regulatory risk around staking. If regulators decide staking is a security or impose restrictions, that impacts the yield component of the model. NAV premium compression risk. If the market decides they don't want to pay a premium anymore, the stock can fall even if ETH is flat or up. Tom Lee is a key person risk. He's a visionary and strategic driver. If he left or lost credibility, confidence could evaporate. These are real risks. This is not a conservative investment. Let me address the obvious question. Which is better, Strategy's Bitcoin model or BitMine's Ethereum model? The honest answer is it depends on your view of the future. If you believe Bitcoin is digital gold and the primary macro hedge, strategy makes sense. If you believe Ethereum is the infrastructure layer for Finance 2.0, BitMine makes sense. If you want pure price exposure with no yield, strategy makes sense. If you want price exposure plus staking yield, BitMine makes sense. If you want the most established liquid proven model, strategy makes sense. And if you want the aggressive newcomer with a bold vision, BitMine makes sense. Personally, I think both theses can be right simultaneously. Bitcoin and Ethereum serve different purposes. Digital gold versus programmable money and infrastructure. Both have enormous addressable markets. So it's not a binary choice. You could own both. Strategy for Bitcoin exposure, BitMine for Ethereum exposure, or neither. Or just owning the underlying crypto directly. But understanding both models helps you make informed decisions. What should you do right now? Understand Tom Lee's thesis. Read his research on Ethereum Supercycle. Understand the stablecoin growth driver. Understand the Wall Street on Ethereum narrative. Then decide if you agree. Calculate BitMine's NAV and premium. The same math as strategy. Current ETH holdings times ETH price, subtract debt, divide by shares, and compare that to stock price. Model the staking yield impact. If they hold 3 million ETH earning 2.5 to 3% annually, that's meaningful income. Value that cash flow stream. Compare to spot Ethereum ETFs. If those are available, compare fees and premiums. Sometimes direct ETF exposure is cleaner and cheaper. Monitor their progress towards 5%. They're at about 3 million ETH now. They need 6.1 million. Watch if they can actually execute that level of accumulation. BitMine is doing something unprecedented. They're trying to accumulate 5% of an entire cryptocurrency supply that's never been done before at this scale. Tom Lee's put his reputation behind Ethereum as the winning smart contract platform for Wall Street, stablecoins, and the future of finance. He's betting that Ethereum supercycle is real. And unlike Bitcoin, BitMine generates actual yield from staking. That 2.5 to 3% may not sound like much, but it compounds, and it means they're growing their treasury even in sideways markets. Whether this model works long-term depends on Ethereum's adoption. If Wall Street really does build on Ethereum, if stablecoins keep growing, if DeFi continues to mature, BitMine is positioned perfectly. If Ethereum loses to competitors or technical challenges derail adoption, this strategy fails. That's the bet, and Tom Lee is all in. Next episode, we're diving into Sol Strategies, the Solana treasury company with a completely different model. They're not just accumulating tokens, they're running validator infrastructure and earning fees from institutional clients. It's the most interesting of the three models in my opinion. You won't want to miss it. I'm Douglas Borthwick. This is Old Men, New Money. If you found this helpful, share with someone trying to understand the different treasury company models.